Welcome to another Watchlist Wednesday. Today's company is JM Smucker Company, ticker symbol SJM. It is a consumer staple company in the packaged food industry, and its current market cap is $13 billion. Most of us probably know the Smucker Company from their famous Smuckers brand of jellies, but they do own several other companies in the packaged food industries, including Jif, Folgers, Pepperoni Milk-Bone, Dunkin' Donuts, Cafe Bustelo, Meow Mix, and many others. So this is a very diverse company that is in both the human food industries and pet food industry. I wanted to show off something really interesting in their most recent report. Their comparable net sales has increased 21%, which is actually very interesting compared to the numbers that we will see in a little bit. Their free cash flow is positive, and they upped their dividend for the 22nd consecutive fiscal year. But the big news surrounding Smucker is their current acquisition of Hostess, the maker of Twinkies, which they acquired for $5.6 billion a few days ago. If we scroll down here, Hostess Brands was acquired for $5.6 billion, including their debt that will unite the two major American snack makers. This deal was worth $4.6 billion on the open market, excluding their debt, and Smuckers paid $34.25 per share to acquire Hostess. This represents a premium of 54% of the current market price of Hostess Brands, which trades on the ticker symbol TWNK. This acquisition was 17.2 times the earnings of Hostess Brands' most recent 2023 results, so not necessarily a huge overpayment, but definitely over what the market was pricing ticker symbol TWNK at earlier. So now that we've seen some of the recent news surrounding Smuckers, let's check out their balance sheet. Revenues are growing, but very, very slowly at less than 2% per year. EBITDA, much the same, a little bit more spotty, but again, about 2% per year it's growing. Gross margins have come down a little bit, but they do still hover in the mid to upper 30%, which is decent. What is a bit more worrisome is that Smucker's return on assets has gone negative. This is something that I don't expect to continue, but it is something to watch because the company is not currently making a very good return. Even before then, they're only making 3 to 5% on their money. Annual operating earnings are generally positive. They did face some headwinds in 2022, but Smucker's does expect to be positive in 2023 and in the future. SJM has been buying back shares over time at about 2.5% per year, which is where we see a decent bit of their growth coming from. Smuckers was increasing their cash on hand, but this was before the acquisition of Hostess Brands, so this number is probably out of date and has dropped quite a bit. Smucker's long-term debt has been pretty steady as well. This is also out of date and does not include their acquisition of Hostess, but it is nice to see that the company is trying to keep a decent and steady leverage ratio over time. Annual interest expenses on that debt has fallen at over 8% per year, which is excellent. The company is getting cheaper and cheaper financing, which is always great to see. Free cash flow is positive for the last 5 years, which is great to see. It is a little bit spotty and not consistently going up, but it is good to see that it is generally stable. Free cash flow per share, again, is generally stable and consistently positive. And Smuckers has been increasing its dividend every year for the last 5 years at a dividend CAGR of almost 5% per year. Smucker's dividend payout ratio is generally sustainable. These last two bars here show 100% due to their negative operating earnings for those two bars, but in general, the company is between 50 and 60 to 70%, which is sustainable. Hopefully, we can see these numbers come back down once their operating earnings go positive again and hover around that 50 to 60% range. And to check out the fair value chart, I want to make a quick note here. This purple line here is at 0 because, again, their operating earnings were negative. So I added this trend line to show the general trend of their operating earnings, and we'll use that as the way to judge fair value. So at a 15 PE, which is what I would consider normal for a company that is not growing very quickly, we do see that SJM is slightly overvalued and has not hit that 15 PE line. Its current forward PE is 13.11, meaning analysts do expect to see decent growth in earnings over the next year. So that could mean that we see some current undervaluation. This is also a very defensive company. So if I add a 17 PE, which is general for defensive companies to trade at a slightly higher than 15 times earnings, what we do see is that Smuckers is in fair value and might have a small margin of safety. It is expected to grow at 7.5% per year, which is actually very decent growth for a defensive company that is well established like Smuckers is. And its PE over growth ratio is 1.75, which is, again, decent for a defensive company. So for a quick recap, what I like about Smuckers is that they have tons of household brands. They're not going anywhere anytime soon. They have a good dividend record. They've been hiking that dividend for 22 years, and it's growing at a decent rate of about 5%, and it's a defensive company. Even in recessions, we're going to see Smuckers continue to create profits because they generally sell food, and everybody needs food. What I don't like is that the Hostess acquisition seemed a bit overpriced, and I'm not sure now is the right time given interest rates are quite high. There is very little growth in the future, the returns mostly come from buybacks of their shares, and that's generally because they're in a defensive industry. Their brands are well established. They're not growing very fast, and they won't be growing fast anytime soon. And the slow dividend growth, 5% isn't bad, especially for a defensive company. But compared to the rest of the market, 5% is below average. And so that is something that is a bit of a negative too. So will I buy Smuckers? For me personally, I think the answer is a yes, and that is for my personal portfolio. I don't have a ton of very defensive stocks, so I am looking to add stuff, even if it is low growth. I do like that Smuckers is ultra defensive. I like their brands. They're brands that do very well even in recessionary times. So for me personally, I think it's a good addition to my portfolio. I also understand though if you do not want to add this company because again, the margin of safety isn't very large, the growth isn't very high, and in general, the returns come from stock buybacks, which is something that can fluctuate. So I'll leave it up to you. If you like this video, please leave a comment, like, and subscribe. It means a lot to me. If there's a company that you want to see analyzed, please let me know, and I'll do my best to get to it. Thanks, guys. I hope you have a great day.